What's up, YouTube? My name is Liam Page. In my last video, I put up this little formula. Interest rates go down, inflation goes up. And in this video, I wanted to just expand on that just a little bit. And so the first key thing that you need to understand is that an interest rate is just your cost to borrow money, right? It's what the bank is charging you basically for the privilege of borrowing money. So you get a 10 grand loan, that's awesome. You get 10 grand in your pocket today, but you're expected to pay it back with a little bit of interest in the future, basically for the bank's trouble and the risk that they're taking in loaning you that money, right? The other thing that you need to understand, which I apologize is also kind of a topic for another video, is that when you borrow money, you're basically creating new money. And this is for a couple of reasons, namely fractional reserve banking, which I'll have to get into in another video. You see how I keep this going here? Keep the little video train rolling. So anyway, from there, it's not hard to extrapolate that when the interest rate goes down, it's getting cheaper to borrow money, right? So when the interest rate goes down, it's now much cheaper to borrow money, right? And as such, inflation is going to go up, right? Because more money is being borrowed and adding more money into the system. And that's why I said in my video, you can essentially think of a lowering of interest rates as just making money cheaper. When money's cheaper, the prices go up. That might sound kind of counterintuitive, but you can just think about it like anything really, you know. A Bic pen, round point or round stick Bic pen isn't worth much because there's billions of them on Earth. A Rolls Royce or a Lamborghini or something, there's not billions of them, there's very few, probably only, in the tens of thousands. So they're more expensive. But I don't want to get too off topic here. Another thing that I'll say really quickly is that, this is going to be yet another video. Inflation does not mean rising prices. Inflation means that the money supply is inflating. And you know what, I guess I can just do it in this video. Inflation means that the money supply is inflating. You can think of it like inflating a balloon. The money supply is getting bigger, and as a consequence of that, we have rising prices. Because there's more money in the system, the money, again, is cheaper, softer, whatever you want to say. It's worthless paper is what it really is. But nonetheless, the money is getting inflated. There's more money in the system, so business owners or whoever are going to demand more of that money, and hence prices are going to be rising. So I hope that makes sense. I hope you enjoyed this little video. Like I said, just a little quick one. I'll go into fractional reserve banking and why borrowing creates new money, because I understand that might seem like a complete black magic statement right there. Why does borrowing money create new money? But it actually makes a lot of sense, and I'll explain it in the next video. So stay tuned. And thanks for watching.